Let's go ahead and talk about potentially dilutive securities. In this segment, I'd like to talk about potentially dilutive securities in general, and then some specific examples with convertible preferred stock and convertible bonds. First, what are potentially dilutive securities? Now, when we computed basic earnings per share, we divided net income minus preferred dividends by the weighted average common shares outstanding. Potentially dilutive securities are securities which, through issuance or exercise, will lead to the issuance of additional shares of common stock. The increased number of shares will dilute earnings per share, since the earnings will be spread over a greater number of shares, basically watering down the earnings per share. Now, there are a few common types of potentially dilutive securities. First, convertible preferred stock, where each share of preferred stock can be exchanged for or converted into a specified number of shares of common stock. Now, why would we do this? Again, preferred stock is not a terribly exciting investment. You might get a fixed annual dividend, and perhaps if you're lucky, there might be a participation feature. But if the company does really, really well, then the common shareholders are going to be the ones who make all the money, and while the preferred shareholders get their safer yet boring fixed return. By making the convertible preferred exchangeable for shares of common, the convertible preferred stockholders can participate or can benefit if the company does really well. By the same token, we might have convertible bonds, where each bond can be exchanged for a specified number of shares of common stock. Again, this makes the bond potentially more attractive, so people will pay more for our bonds, thereby lowering our borrowing cost. We also will have to deal with stock options. Stock options give the holder the right to buy shares of stock at a fixed price for a fixed period of time. Now, stock options that we're going to be talking about are usually granted in the context of incentive compensation plans. But basically, there are two broad types of stock options. Again, the ones we're going to be concerned with are the ones granted by the company. There are, however, also publicly traded stock options. These aren't granted by the company. Instead, these are a contract between two individual investors in the financial markets. Stock warrants, functionally similar to stock options, where they give the holder the right to buy shares of stock at a fixed price for a fixed period of time, but they're usually issued in conjunction with other securities. Again, to make our bonds more attractive, for example, we might say that each $1,000 bond comes with 5 stock warrants that enable you to buy stock at a fixed price for a fixed period of time. Finally, we might also have contingent issuance agreements, and these are agreements where additional shares of stock will be issued if some contingency is met. For example, if some specific earnings target is met, or if some specific sales growth target is met. Let's go ahead and talk about convertible bonds first. When convertible securities are issued, no recognition is given to the conversion feature at all. The conversion feature is said to be inseparable from the underlying security. If you've got a convertible bond, if you own the bond, you own the convertibility. You can't keep the bond and sell the conversion feature. It's not a separable investment. Now let's go ahead and start with an example where that on January 1st, 2001, we're going to issue $100,000 of 10% 10-year bonds at 103, and we'll use straight line amortization. Each $1,000 bond is convertible into 200 shares of $1 par value common stock, and on May 1st, 2002, all of the bonds are converted, and the price of the common stock on that date was $9 per share. Again, at issuance, we're not going to give any recognition to the conversion feature at all. We're going to treat this like any other bond issuance. So we take in $103,000 from our new bond buyers. We record a bond payable liability at face value, and the additional $3,000 is a premium on bonds. At the end of the year, we do our annual interest and amortization. We have our coupon interest, again $100,000 times 10% for a year, and we have our amortization, a $3,000 premium spread straight line over 10 years at $300 per year. Continuing the same example, again, now we're going to assume, again, same example, now we're getting to the point where the bonds are actually converted. This is going to be just like an early bond retirement that we talked about previously. The only difference is, what do we surrender to reacquire the bonds? Previously, when we repurchased bonds, we wrote a check to buy the bonds back. Now we're going to be issuing shares of stock to reacquire the bonds. All of the same mechanics, all of the same procedures. It's just a question of what do we credit when we reacquire these bonds. So the first step will be, of course, to bring our interest and amortization up to date. We have our coupon interest, and again, it's $100,000 times 10% equals $10,000 per year, and we want it for 4/12 or 1/3 of a year. Likewise with our amortization, it was $300 per year, so for 1/3 of a year, it'll be $100. Now we're going to go ahead and retire the bonds. Now there are two methods by which we can record the conversion, and we'll start with the book value method, which is the most common by far. Okay, we're going to, just as we did when we reacquired bonds for cash, we have to take the bonds payable off the balance sheet. We're going to take the remaining premium off the balance sheet, and again, the premium started at $3,000. We amortized $300 last year, we amortized $100 a minute ago, and so we've amortized $400, so there's $2,600 left. And we're also going to satisfy that interest payable liability. So we're satisfying, if you add those three things together, we're satisfying $105,933 of liabilities. Under the book value method, we will assign to the stock that we're issuing the book value of the debt that was being eliminated. So if we eliminate $105,933 of liabilities, we're going to create $105,933 of equity. The common stock account, of course, goes in at par value. Now again, we've got $100,000 bonds. Each of those 100 bonds is convertible into 200 shares of stock, so that's 20,000 shares at a $1 per share par value. So the common stock gets 20,000 of that total. The paid-in capital in excess of par gets the other $85,933. And again, what's happened is we've taken $105,933 of debt off the balance sheet and replaced it with $105,933 of equity. The alternative to the book value method is what's referred to as the market value method. The market value method is seldom, if ever, used because it almost always leads to a loss on conversion, which we'll illustrate in just a moment. Again, we're going to have the same example as before, and as before, May 1st we bring our interest and amortization up to date, just like last time. Now when we go to retire the bonds, again, we're going to go ahead and take the bonds payable and the premium on bonds payable and the interest payable off the balance sheet. So there's our $105,933 again. But now we're going to assign to the stock the market value of the shares being issued. And again, we're issuing 20,000 shares of stock worth $9 each, or $180,000. So again, the common stock goes in at par value, 20,000. Now, the total value of the stock is 180, so if the common stock is 20, then the paid-in capital in excess of par must be 160. Now, in this case, we've surrendered $180,000 worth of stock to satisfy $105,933 of liabilities. We, in a sense, overpaid by $74,000, and that'll be our loss on conversion. And again, generally, use of the market value method will always lead, almost always lead, to a loss on conversion. People won't convert the bonds unless the stock is worth more than the bonds. So the only time the conversion is going to take place is when we're surrendering more in terms of the value of the stock than the value of the liability that's being satisfied. So it will always end up that we're going to have a loss on the conversion. That's why firms virtually never use it. Okay, finally, let's deal with a case of convertible preferred. And again, let's do an example. Assume that on January 1st, we issue 100,000 shares of $100 par 6% convertible preferred at 108. Each share is convertible into 20 shares of $1 par value common, and on June 1st, 100 shares are converted when the market price of the common is $8 per share. And again, at the issuance, we're going to treat it like any other issuance of preferred stock. We take in $108,000 from our shareholders. Preferred stock goes in at par value, $100 per share times 1,000 shares, and the excess goes to paid-in capital in excess of par dash preferred stock. Now, in the case of the conversion of preferred, we must use the book value method. This is an equity transaction. We can't have a gain or a loss on an equity transaction, so we can't use the market value method. Instead, we're going to use the book value method, where we will take away the book value of the preferred stock that's being surrendered and replace it with an equal amount of common stock. So if we're going to convert 100 shares of preferred, we need to remove the equity associated with those 100 shares. Now again, those shares were sold at $108. So we're going to take away preferred stock at par value, 100 shares at $100 apiece, and we're also going to take away the paid-in capital in excess of par on those preferred shares, 100 shares at $8 apiece. So we've taken $10,800 of preferred equity off the balance sheet. We're going to replace it with $10,800 of common equity. Again, the common stock account at par value, 100 shares of preferred times 20 shares of common per share of preferred, so 2,000 shares. The remainder paid in capital in excess of par. Again, we're simply swapping one category of equity for the same amount of another category of equity.